The Federal Reserve has just decided to lower interest rates for the third time this year by 0.25%. In this video, I'll go over what that means for you, for the economy, and how you can use this information to come out ahead. As an aside, the Fed made this decision completely in the dark, completely in the blind, because not that long ago, the government was shut down. Consequently, the jobs and labor report never came out. So they never had this information, yet they still decided to lower the interest rates. First things first, what does a rate cut mean? Basically, it means that the interest rate is coming down. The interest rate is set by the Federal Reserve, aka the Fed. This is the central bank of the United States. Although it is an instrument of the US government, the Fed maintains its neutrality and independence from the government and is free to make decisions without the support of the government, officially. And the main dial that the Fed has to affect monetary policy is setting the interest rates. Interest rates have a drastic impact on the economy. Every sector of the economy is affected by the interest rates. For example, car loans, real estate loans, mortgage loans, student loans, credit card loans, business loans. The list goes on and on. No sector of the economy is unaffected by the interest rates that the Fed sets forth. Therefore, the interest rate plays a major role in the economy. In general, when the economy is doing bad, the Fed lowers the interest rate to stimulate the economy, spurring growth and expansion. And conversely, when the economy is doing good, the Fed raises the interest rate to prevent the economy from overheating and to stabilize prices and prevent hyperinflation. So the Fed doesn't just cut interest rates for fun. They do it to stimulate the economy. They want to promote business growth, expansion, borrowing and lending, more spending, and they want to loosen the monetary policy, possibly ushering another era of quote-unquote easy money. Now, the looming side effect of lowering the interest rate, and that is on everybody's mind, is higher inflation. Lowering the interest rate in general causes higher inflation. And guess what, you guys? What is the number one concern that is top of mind for most Americans? It is the high inflation, the high cost of things, the high prices that we are facing. And yet, in spite of that, the Fed is still deciding to lower the interest rates. Later in this video, I'll go over exactly what that means for you. During the press conference that the Federal Reserve Chairman Jerome Powell held, a member of the press asked Mr. Powell this very question. If inflation is top of mind for everybody, why lower the interest rates now? And essentially, Jerome Powell's response was that by lowering the interest rates, it stimulates the labor market and more people are going to make more income, more money, and that will outpace inflation, according to Jerome Powell. That's his take on things. Now, this segues us into a natural discussion of the difference between hawkish and dovish monetary policy. And it appears that we are transitioning to a dovish monetary policy. Let me explain. Doves favor economic expansion. They favor low interest rates, more economic growth, more business opportunities, more business loans, just easier money, quantitative easing. Of course, the side effect of this dovish position is higher inflation, the fact that things are going to cost more. In contrast, there is the hawkish monetary policy. Hawks believe in controlling pricing at the expense of economic expansion. They believe in keeping interest rates high in order to stabilize prices. They would rather sacrifice economic expansion in order to prevent hyperinflation from happening. There is a constant tension and a constant battle between the hawks and doves, and it's always a balancing game between these two. And the Fed needs to constantly thread the needle. It needs to constantly walk this tightrope to balance the economy. If they lower the interest rates, then the economy, of course, will be boosted. Businesses will have an easier time expanding, taking on loans, taking on debt. But the side effect is that inflation will go up as well. Conversely, if they raise the interest rates, then that may stall the economy, putting a brake on things, possibly even leading to a recession. But it will stabilize prices and it will prevent hyperinflation from occurring. The Fed has to balance many aspects. They have to take into consideration inflation shocks, the status of the labor market, the aftermath of the pandemic, as well as face political pressure and keep the economy afloat. You know, I did my research and I came across something very interesting. I found that all the most recent bear markets, aka recessions, happened after the Fed cut interest rates. This happened in the early 2000s in the dot-com boom. This happened in 2008, 2009 as well. And finally, during the 2020 pandemic. Does this mean that rate cuts caused the markets to drop? It might be tempting to think this way, but no, the market did not drop because of the rate cuts themselves, but rather to the events that caused the rate cuts in the first place. In other words, the economy was already slowing down before the rate cuts. Then the Fed cut the rates in order to stimulate the economy, and finally the market fell into a recession. But of course, I'm just explaining what happened in the past, and it's always the usual disclaimer that past outcomes do not affect future outcomes. I'm just explaining what the historical data shows. This is all publicly available information, and this information has likely been completely combed through and accounted for. You know, it's always the same thing. The more you dive into a topic, the murkier it gets. But I'll still try to explain what you can do to exploit this information. This has to do with the efficient market hypothesis, which basically says that the very act of predicting something affects its future outcome. In the end, in the short term, nothing can be predicted, because all the data available has already been accounted for and priced in. Now, this is what you came here for. What does the rate cut mean for you, and how does it affect you? Well, let me explain. It's going to be more of the same thing. We're seeing the rich get richer and the poor get poorer, unfortunately. And this rate cut, in my opinion, in my mind, will only exacerbate that. The wealthy will continue to build their wealth because they own assets that will go up in price. For example, real estate, stocks, businesses. All these things in a low interest rate environment tends to go up. Borrowing is easier. Expanding your business is easier. Taking on more loans for your business becomes cheaper. So the economy is going to heat up once again. And conversely, those on the other side will be completely left in the dust. Those with no businesses, no stocks, no real estate, no assets, they will be completely left behind. And they will become victims of yet further inflation. Their savings is at risk of further devaluation, and their purchasing power is decreased. The wealth gap, the K-shaped economy, is going to get even worse after this rate cut. People who continue leaving their money in just a savings account will die a very slow death. As interest rates go down, so does the savings rate that banks pay out. Once again, it looks like the savers will be losers. But please don't misinterpret me. Don't think that I'm saying that saving your money is bad. What I am saying, listen to this, what I'm saying is that saving your money is just the first step. Obviously, you have to have savings, that's the foundation. But that's just the first step, because you have to take the next step, which is investing your savings. Putting your savings to work in things like stocks, in things like real estate, buying assets, buying cash flowing businesses. These are the actions that will make you successful in today's economic climate. That's why it's so important to get educated about personal finance, about the economy, and that's why I put these videos out, to inform and to give people a leg up in today's society. And looking forward to this next year, I believe that the dovish monetary policy, the quantitative easing yet again, will continue its course. The easy money, the quote-unquote easy money, will return. Federal Reserve Chairman Jerome Powell's term is set to end on May 2026, and all signs lead to a successor being one who will continue this dovish monetary policy that favors economic expansion at the expense of inflation. Essentially, I believe that they'll be pushing the same agenda of quantitative easing, making money flow easier, loosening up the monetary policy, and favoring economic expansion over pricing stability. In the meantime, just personally, what I'm doing is still the same thing, dollar cost averaging, Whether things are going up or down or sideways, it doesn't matter to me. I am consistently and continually going to invest my money no matter what, because I simply just don't know what's going to happen in the short term. Nobody does. It's the only thing that makes sense. It's the only logical thing. In this era where there is so much data, overthinkers are the ones who get punished. I have no idea what's going to go on in the market short term, but I'm just going to consistently buy into the market. Alright guys, I've said it before and I'll say it again. It's the same message that I'm going to hammer home. Just continue living below your means. Stay humble, stay low key, keep saving your money, keep investing. This is Alex from Low Key Millionaire here. I'll see you in the next one. Bye.